Ever get that feeling like, when you're reading the economic headlines and everything seems pretty good on the surface,
Yeah.
but I don't know, you just have this nagging sense that there might be
Right.
something lurking beneath, right? Something we're maybe not seeing
Absolutely.
that could turn the whole thing upside down.
It's that kind of, the calm before the storm feeling.
Exactly. Yeah, the calm before the storm. And that's kind of what we're going to dive into today. We're looking at ways to maybe spot those hidden risks
Right.
before they blow up into a full-blown crisis.
Yeah.
Think of it as developing that early warning system
Right.
for the economy
Hmm.
so we can be prepared.
Yeah, like an economic weather forecasting system. We're trying to
Exactly.
look at the radar and see if there's any storms on the horizon. We've gone through a bunch of research, and a Bank of England working paper really caught our eye. And we think it has some crucial insights you should know about. Our goal today is to give you a clearer picture of what might be signaling rough waters ahead,
Got it.
without getting lost in all the technical jargon.
Absolutely. So in this deep dive, we're really zeroing in on something called macroeconomic tail risks.
Yeah.
And specifically, we're interested in how certain financial vulnerabilities can be like those canaries in the coal mine,
Right.
for big economic downturns, maybe like 3 to 5 years out. And the study we're using for this is called Credit, Capital, and Crises, a GDP at risk approach.
Okay.
And they really went deep. They analyzed data from 16 advanced economies over several decades.
Right.
So it's not just theory, it's based on actual historical evidence.
Yeah, and that's what makes it so valuable, I think, for our listeners, is it's not just qualitative, hand wavy, like, oh, this is a risk, this is a problem.
Right.
They actually try to quantify it. They look at historical data and they say, okay, when we've seen credit grow at this pace, what has that meant historically for the likelihood of a really bad recession?
Right, right.
So our mission today is to sort of equip you with the tools to understand which factors you should be monitoring,
Right.
and why they're important for, the overall health of the economy. So yeah, this is your shortcut to becoming an expert.
I love it. A shortcut to becoming an expert. Okay, so let's break down this idea of GDP at risk. It sounds kind of, academic and jargony.
Yeah. Yeah.
But the concept itself is actually pretty straightforward.
Right.
What is GDP at risk really telling us?
So simply put, GDP at risk is a way to measure how bad things could get for the economy
Okay.
over, the medium term, let's say the next 3 to 5 years.
Okay. Yeah.
And what the researchers did is they specifically focused on what's called the fifth quantile of projected GDP growth. Now, what that means is imagine 100 different ways the economy could go over the next few years. The fifth quantile is like the line where only the 5 worst outcomes out of those 100 would fall below.
Oh, okay. I see.
So it's not about predicting the most likely scenario. It's about understanding
Right.
how bad things could potentially get.
Okay. So it's not about what's most likely to happen.
Right.
It's about understanding the scale of those less likely,
Right.
but far more painful scenarios.
Exactly. It's like paying attention to the rumbles of thunder in the distance.
Yeah.
Even if the sky above you is still clear, you want to be prepared.
Right, right. Okay, so what are the rumbles of thunder that this research is pointing to?
So they identified a few key indicators that have historically been associated with a higher GDP at risk.
Okay.
And the first one is something that you've probably heard of before, credit booms.
Okay.
So what they found is that a large increase in the amount of credit in an economy, particularly when it's growing much faster than the economy itself, measured by GDP over a 3-year period, that tends to be a major red flag.
So it's not just that people are borrowing more.
Right.
It's that the borrowing is growing at a much faster rate than the economy is expanding.
Exactly. Yeah. It's that relative growth.
Right.
That's really important.
And why is that such a concern, according to the research?
Well, what's really interesting is that they were able to quantify the impact. So they found that a 1 standard deviation increase in this 3-year credit growth relative to GDP was associated with a 0.9 percentage point cumulative deterioration in GDP at risk over the following 3 years.
Okay, so let's unpack that a little bit. 1 standard deviation. What does that actually mean in this context?
So when we talk about a standard deviation, we're basically talking about how spread out the data is.
Okay.
So 1 standard deviation increase represents a pretty significant jump
Okay.
in that particular indicator. And this finding actually lines up really well with a lot of previous research, looking at banking crises, currency crises, so rapid credit growth. Historically, it's a pretty strong predictor of a future economic pain.
It makes sense, right? You have rapidly increasing levels of debt
Right.
that can really amplify any future economic difficulties.
Exactly.
And they had some pretty striking numbers to back that up too, right?
Yeah, they did. They looked at the most severe GDP declines in their data set. So, the really bad recessions.
Yeah.
And they found that in 73% of those cases, credit growth in the 3 years leading up to the downturn was above the country's average.
Wow, that's a pretty strong link.
Okay.
So, rapid credit growth,
Yeah.
definitely something to watch out for. What's next on the list of potential problems?
Okay, so the next one is property price booms. And this is pretty similar to what they found with credit. So rapid increases in real house prices over a 3-year period.
Real house prices meaning adjusted for inflation.
Exactly.
So we're not just talking about prices going up because, the cost of living is increasing in general.
Right. Yeah, we're talking about house prices increasing faster than inflation.
Gotcha.
And they found a pretty concerning impact here as well. So one standard deviation increase in that 3-year real house price growth was linked to a 0.75 percentage point cumulative deterioration in GDP at risk.
Okay, so again, we're seeing, a substantial increase in the potential for a significant economic downturn.
Right.
If house prices are surging, even when you account for inflation, that's another red flag, potentially.
Another warning sign to pay attention to.
And they had some interesting stats on this one too, right?
Yeah, they found that 71% of those major GDP crashes that they looked at were preceded by real house price growth that was above its long-term average.
Okay. So just like with those credit booms, these rapid run-ups in property values, they often come before those really bad recessions.
Right.
Okay. So we've got rapid credit growth, we've got property price booms. What else did they highlight?
All right. The third big one is wide current account deficits. Now, this one might be a little bit less familiar.
Yeah.
To some people. But basically, a current account deficit means that a country is importing more goods and services and investment income from abroad than it's exporting.
So the country is spending more
Right.
on the rest of the world than it's earning from it.
Exactly, yeah.
Okay.
And while a small current account deficit isn't necessarily a problem, a large and persistent deficit can be a real vulnerability. And what they found in the study is that a 1 standard deviation increase in the current account deficit was linked to, get this, a 1.5 percentage point
Wow.
cumulative deterioration in GDP at risk over 3 years.
That's the biggest impact so far.
That's the biggest one.
Out of the 3. Okay, so nation spending significantly more abroad than it earns.
Right.
That's something to really pay attention to.
Yeah.
Why is a large current account deficit like that such a concern?
So if we think about what that means, it means that a country is relying on borrowing from other countries to finance that gap. Right. And so if those foreign lenders become less willing to lend, or if there's a sudden shift in those capital flows, it can put a huge strain on the economy and potentially trigger a crisis.
Right.
The study actually highlighted how this was a significant factor in the lead up to the global financial crisis in both the UK and the US.
Interesting. Okay, so that really highlights how interconnected, the global economy is.
Absolutely.
How imbalances in international trade and investment can set the stage for those future problems.
Yeah.
Okay, so the study wasn't just about what could go wrong, though, right?
Right.
They also looked at factors that could potentially mitigate some of those risks.
Yeah, yeah. And this is where it gets really interesting, I think, for thinking about how we build more resilient economies.
Okay.
So they looked at bank capitalization. And essentially what that means is how much capital or loss-absorbing funds banks have relative to their assets.
Okay.
So think of it as the cushion that banks have to absorb unexpected losses. And their key finding here was that higher bank capital actually reduces the increase in risk
Okay.
coming from all those other vulnerabilities we talked about.
So banks that have a strong financial foundation
Right.
can act as a buffer against those negative consequences
Exactly.
of rapid borrowing, surging house prices, those large trade imbalances.
Yeah, and they even quantified the impact. So they found that a 1 standard deviation increase in bank capitalization was linked to a 0.9 percentage point improvement in GDP at risk.
Okay, so that's that's a pretty significant counteracting force.
Yeah.
So well-capitalized banking system can really improve an economy's ability to kind of weather those storms.
Yeah. It's like having, strong shock absorbers on your car when you're driving down a bumpy road.
I like that.
Yeah.
Okay, so how much of a difference can this make? Like, did they give any sense of that?
Yeah, they did. So they estimated that if policymakers had used something called a countercyclical capital buffer, which is basically a tool that requires banks to hold more capital during good times before the 2008 financial crisis.
Right.
It could have offset somewhere between 20 and 40% of the increase in GDP at risk.
Wow.
So that's potentially a really big impact.
That's huge. Okay, so that really underscores the importance of those kind of proactive, regulatory measures. Now, the study also touched on financial conditions and volatility in asset markets.
Right.
Where do those fit in?
Yeah. So what's interesting is that while financial conditions, things like, how easy it is to borrow money, interest rates, and volatility in asset prices, like stock market swings,
Yeah.
those are important. What they found in the study is that those impacts are most pronounced in the near term.
Okay.
So up to about a year out. They didn't find a statistically significant direct impact on GDP at risk 3 years out,
Okay.
once they accounted for those fundamental vulnerabilities like credit and house prices.
So while those short-term market swings matter, those deeper underlying imbalances,
Right.
those are more critical for that kind of medium to longer term stability.
Yeah, they basically concluded that those vulnerabilities, the credit booms and house price booms, might be the channels through which looser financial conditions actually create those longer term risks.
Oh, interesting. Okay, so easy money might fuel that borrowing, inflate asset prices,
Right.
and then create the conditions for that future downturn.
Right.
Okay, so that's really nuanced, and it suggests we need to look beyond just how the markets are feeling at any given moment
Right.
and pay attention to those deeper imbalances.
Yeah.
Now, the study also looked at some real-world examples, focusing specifically on the UK and the US. What did their analysis reveal in those cases?
So their analysis of the UK and the US was pretty fascinating. So their model was actually able to identify periods of increasing GDP at risk in both countries,
Okay.
leading up to the recessions in the early 1990s and the global financial crisis.
Okay.
And these increases in risk were tied to, you guessed it, rapid growth in credit and house prices.
Okay. And were there any specific differences or additional factors at play in each country?
Yeah, for the UK, leading up to the global financial crisis, they also highlighted a widening current account deficit
Okay.
and a decline in those capital levels in the banking system.
Okay.
For the US, the buildup of risk before the early 1990s recession, that was associated with credit and house price growth and a banking system that wasn't quite as well capitalized.
Okay.
And then leading up to the mid-2000s, they saw that significant buildup again, driven by credit, house prices, and a widening current account deficit.
Interesting. So it seems like these weren't just isolated incidents,
Right.
same patterns of vulnerability appearing in different countries, different times,
Right.
before those big economic downturns. And the study also touched on potential policy responses.
Yeah.
Specifically, this countercyclical capital buffer. How does that fit in?
Yeah, so this is really the question for policymakers, right? Like, what can they do with this information?
Right.
So, as we mentioned earlier, the countercyclical capital buffer, it's designed to require banks to hold more capital during those risky periods.
Right.
And the study actually did a little hypothetical exercise looking back at the period before the 2008 crisis. And they found that if a countercyclical capital buffer had been in place back then and used to increase those bank capital levels, it could have significantly reduced that spike in GDP at risk.
Okay, so that's a pretty powerful potential use of this research, right?
Yeah.
Proactively requiring banks to have that bigger safety net during good times.
Right.
So you can kind of lessen the impact when things eventually turn bad.
Yeah,
Of course, as the study acknowledges, this is all in hindsight, right?
absolutely.
The real world is always a lot more complex.
It's a retrospective analysis, and these things are very difficult to do in real time.
Yeah.
But it does highlight the potential benefits of these kinds of policies that are aimed at the stability of the whole financial system.
Right. Okay, so the study didn't just focus on the worst case scenario, that fifth percentile.
Right.
They also looked at the broader picture
Yeah.
including those more likely outcomes,
Yeah.
right?
Yeah. They also looked at the 50th percentile, so the median or most likely growth rate,
Okay.
and the 95th percentile, which is like, a really good scenario.
Right. Right.
And what they found is that the impact of those vulnerability measures that we've been talking about,
Yeah, okay.
they generally pointed in the same direction across all those different potential outcomes. So, for example, higher credit growth tended to be bad, whether you're looking at the best case, the worst case, or the most likely scenario.
But the strength of that impact could vary.
Exactly. And that was particularly true in the short term. So things like the rapid credit growth and asset price volatility had a much bigger impact on that risky fifth percentile in the near term compared to the median or that very optimistic 95th percentile.
Interesting.
And they also found a potential trade-off with bank capital. So it seemed like higher capital levels might be associated with slightly slower average growth in the short term,
Okay.
but they provided a lot more protection against those severe downturns over that medium term.
Okay.
So policymakers might face this choice between, a slightly slower but safer path versus a potentially faster but riskier one.
Right. Right. That's really interesting. And it highlights how, economic policymaking is often about balancing those different potential outcomes
Absolutely.
and thinking about those different time horizons.
Mhm.
Okay, so we've covered a lot of ground here.
Yeah.
From understanding what GDP at risk is
Right.
to looking at those warning signs and thinking of potential policy responses.
Right.
What are the key takeaways you think our listeners should walk away with?
So the main thing is this. Big increases in borrowing relative to the size of the economy. Rapid increases in house prices, even after you account for inflation. And large persistent deficits in a country's current account.
Right.
Those are all major warning signs
Okay.
for potential economic trouble in the medium term. They're not just random things. They have this really strong historical link to those significant economic slowdowns. On the other hand, a banking system that has a lot of capital acts as a crucial safety net.
Right.
It helps to absorb shocks and reduce the negative effects of those vulnerabilities.
Okay, so listeners who want to stay informed, those are the indicators they should be watching for
Right.
in the economic news and reports.
Right.
It's not just about what's happening with economic growth right now.
Exactly.
It's about those underlying
Yeah,
dynamics
exactly.
that can signal future risks.
And I think this research gives us a framework to understand that
Yeah,
and keep an eye on those risks. It gives us a way to systematically think about what could go wrong.
absolutely. So as we wrap up, here's something I want you to think about. Thinking about those indicators, rapid credit growth, soaring house prices, those big trade imbalances.
Right.
What are some potential areas of concern in the current global economic landscape?
Yep.
I think it's really worthwhile to look at what's happening in the world today
Absolutely.
through the lens of what we've talked about.
Yeah, and I think if you're interested in digging even deeper into this, I would encourage you to look for those reports that central banks and international financial institutions put out,
Right.
because they often talk about these indicators
Right.
in their assessments of economic and financial stability.
Okay.
And remember, this is an ongoing area of research and policy discussion.
Absolutely.
So staying informed is key.
Well, thanks for joining us for this deep dive. Hopefully it's given you a new and valuable perspective on the forces that shape the economy. Until next time, keep learning and keep asking those questions.